Hi, this is Andy Filipiuk in Toronto for the week of May the 2nd. Well, today the Federal Reserve did what was expected. They raised 50 basis points to 0.75% to 1%, and they also announced that they will be running off their balance sheet starting June 1st, taking $47.5 billion per month, and then in September doing $97.5 billion per month. So the tightening is definitely going to happen, but it has already started because we're seeing the spreads between government bonds and corporate bonds widening dramatically this year. So the talk that the Fed has brought us has created this tightening situation. Now, I listened to a fantastic interview with Daniel DiMartino Booth, and who is a former Federal Reserve insider, along with a quantitative easing trader from the Fed. And it was very, very interesting discussion because both of them show and describe just how difficult it is now in the credit markets. For example, with this focus on the US or Canada, what's often left out is what's happening globally. And DiMartino Booth points out that there's over $1 trillion of US denominated debt internationally, non-financial companies, that has to be rolled this year. So for companies that are in foreign markets, with the US dollar going up, it means it's going to be more costly to roll that debt. With the interest rates higher, it's going to be more expensive to roll that debt. And as we're seeing in the bond market now, it's harder and harder to do new issues. So this is going to be Powell's real dilemma, is trying to keep the economy going as credit tightens dramatically in the real estate market, but also in the corporate bond market. Now, their conclusion is the Federal Reserve will probably pretty much ignore the stock market, so it could continue to go down, but they are going to absolutely have to step in to try to support the credit markets. And what this means is that interest rates probably aren't going to go too much higher from here, and the Fed will have to also put support into the credit markets to allow the credit markets to function properly. So in their conclusion, we may be close to being done from what the Fed is telling us, because the markets have already started to react quite dramatically. Tightening is the opposite of the inflationary process, and as market participants know, it's showing up in the price of stocks and bonds right now. I think we can expect more to come over the next couple months. Thanks for watching.